Most real estate investors believe that if their rental shows a loss, it should automatically reduce their W-2 income. In many cases, that assumption is wrong, and some investors don't realize it until they've already built multiple properties expecting those losses to lower their taxes. Now, in a moment, I'm going to explain the specific rule that determines whether rental losses actually reduce taxable income. Because this is where many investors misunderstand how the tax rules really work. One of the most common assumptions I hear goes something like this. If my rental shows a loss on my tax return, that loss should reduce my overall income. Well, after all, depreciation can create paper losses, even when a property produces positive cash flow. So it seems logical that those losses should offset other income. But under the tax code, rental activity is usually classified as passive, and passive losses generally cannot offset non-passive income, like your W-2 wages. In this video, I'll explain why rental losses are often limited, where the misunderstanding usually happens, and what determines whether those losses are actually usable. But before we get into that, if we haven't met before, my name is Lisa Marie Odeja, and I am a CPA and Enrolled Agent specializing in tax strategy for profitable real estate investors and established business owners. Now, before running my firm, I worked as a federal government auditor, reviewing financial records and evaluating whether positions were properly supported under the rules. It's exactly that background that shapes how I approach tax strategy today. Now, back to the passive activity rules. Under the passive activity rules, rental real estate is generally considered a passive activity. Now, that classification matters because passive losses typically can only offset your passive income. They generally cannot offset non-passive income like your W-2 wages. So, even if your property generates a tax loss on paper, that doesn't automatically mean your total tax liability decreases. The limitation isn't about whether the loss exists. It's about how the activity is categorized under the law. Now, there are exceptions, including the real estate professional status and certain participation thresholds. But unless those requirements are met, rental losses are usually limited. And this is why some investors don't discover the issue until years later, after they've structured multiple properties assuming those losses would reduce their taxes immediately. Now, from an audit perspective, this misunderstanding can become quite expensive. If losses are applied incorrectly, the IRS can disallow them, and that can lead to additional tax assessments, penalties, and interest. And by the time the issue surfaces, several years of returns may already be affected. So The real question isn't, did my rental generate a loss? The real question is, how is the activity classified under the passive activity rules? Because tax outcomes depend on structure and participation, not just negative numbers on a return. Effective real estate tax planning isn't about chasing deductions. It's about structuring investments so the rules work in your favor. And that requires understanding classification before decisions are made. Real estate can absolutely be powerful from a tax perspective, but the benefits usually come from planning and structure, not assumptions. If you'd like to explore how these rules apply to your real estate portfolio, you can schedule a brief consultation using the link below. Now, on that call, we'll discuss your current tax situation and your entity structure. I'll also explain how my firm approaches proactive tax strategy and what the next steps would look like if we decide to move forward. If this was helpful, like the video, leave a comment, and share it with someone building a rental portfolio. And don't forget to subscribe so you don't miss future breakdowns on real estate tax strategy. Thanks for watching, and I'll see you in the next video.